This is the worst squeeze we've seen since 2011 from a CPI breadth perspective. So what we're showing you here is the percentage of components registering, again, rate of change, sequential accelerations. You have not seen a sequential acceleration, and again, it's what happens on the margin to the consumer that matters most, particularly with these median consumers that are getting pinched. We haven't seen a rip like this since 2011. Again, 2011 is the last time utilities outperformed financials by over 3,000 basis points. So again, you look at the early cycle versus a bond. Again, this is why bonds look good, we think, because the marketplace is discounting a consumer slowdown that's based on inflation that's accelerating, that consensus Wall Street is still behind on. The Fed will actually say, hey, we wanted it. Well, the Fed might want it. Wall Street might want it. People who are long bonds or gold or anything yield chasing might want it. But the 80% of America that has to eat it doesn't exactly want it. So just keep that in the back of your mind. Now, meanwhile, the 3Q comps on the top line, what we spent a little bit of time here on so far, is the causal factor that is inflation slowing growth, which I, by the way, think will be the great failure of the Federal Reserve, is that they promised you real growth, and what you really got was spits and starts of inflation. Inflation is not real growth. I think everybody on this call knows that. Real growth would be something like a CapEx cycle, an investment cycle, savings going up, which can perpetuate growth. Obviously, you have to have savings to perpetuate investment growth. But again, look at the comps from a top-line perspective. We've been spending time on the other part, which is inflation. But 3Q GDP comps get tougher into the third and the fourth quarter. Don't forget that last year when we were bullish on inflation accelerating, again, slope of the line, we ended up getting a 4.1% GDP number in the third quarter. That's a very difficult comparison. So again, if nothing changed, the comps are going to get more difficult, in particular on GDP reporting, because the deflator component combined with that top line, deflator again gets subtracted from the top line to get you real. The deflator was tracking pretty close to a 40-year low last year. So the deflator goes up, it's math, the top line comes down because GDP gets reported on a real basis, and consensus continues to be surprised to the downside in terms of both growth and bond yields. So again, that's our call on that.